Your realtor in Florida is sweating right now. Not because of the humidity, because 15 of the 20 steepest home price drops in America just happened in their state. More than 30 insurance companies either collapsed or ran for the exit, and the average Florida homeowner is now paying over $8,000 a year just to insure a house that's worth less than it was yesterday. Today, we're counting down 11 Florida cities where home prices are in genuine freefall. And the force behind it all is an insurance crisis so severe that it's rewriting the entire math of homeownership in the Sunshine State. Along the way, you'll see a city that cratered 25% from its peak while nobody was looking. A condo owner staring down a $400,000 special assessment on a unit they bought for less than that. A metro that's growing faster than any city in America and still watching prices drop. And a region where hurricane season didn't just damage homes, it permanently broke the market. Subscribe now, or I'll assume you enjoy paying $8,000 a year for insurance. Your call. No judgment. A little judgment. Number 11, Palm Bay. If you've never heard of Palm Bay, that's kind of the point. It sits on Florida's Space Coast, tucked between Melbourne and Titusville, and for years it was one of those quiet, affordable corners of the state where middle-class families could actually buy a house without selling a kidney. That math stopped working. Zillow data from early 2026 puts the typical Palm Bay home value around $338,000, down nearly 4% year over year. Which might not sound catastrophic until you realize that 4% on a $350,000 home is roughly $14,000 in equity that just vanished. That's not a rounding error. That's a used car. The Palm Bay-Melbourne-Titusville metro has been flagged by multiple housing trackers as one of Florida's consistently declining markets, and the reasons stack up fast. FEMA's Risk Rating 2.0, which rolled out in full in April 2023, reclassified flood risk across the state. The result for Palm Bay was predictable and painful. Flood insurance premiums started climbing, and roughly 80% of Florida's 1.7 million National Flood Insurance Program policyholders are facing annual increases capped at 18% per year, until the new risk-adjusted rate is fully phased in. Translation? Your flood insurance isn't done going up. It's on a slow escalator that keeps climbing every renewal cycle. Combine that with homeowners' insurance premiums that averaged over $8,000 statewide in 2025, according to Insurify, and Palm Bay's affordability advantage starts looking like a mirage. The homes are cheaper, sure. Everything around owning the home is not. And here's what makes the insurance number so brutal. The national average for homeowners insurance is about $2,900. Florida's average is nearly 3 times that. Some of that gap is hurricane risk, obviously, but a huge chunk of it traces back to something most people outside the insurance industry never heard about. Between 2020 and 2023, more than 30 Florida insurance companies either went insolvent or stopped writing new policies in the state. Gulfstream, St. John's, Lighthouse, Southern Fidelity, Weston, FedNat. One after another like dominoes in a windstorm. National carriers like Farmers pulled out entirely. Progressive and AAA reduced their exposure. And all those abandoned policy holders got funneled into Citizens Property Insurance, the state's insurer of last resort, which ballooned to 1.4 million policies by September 2023. Citizens has since depopulated down to roughly 385,000 policies. Rates are starting to ease slightly in 2026. Governor DeSantis announced an average 8.7% rate cut for Citizens renewals. But starting to ease still means Florida homeowners are paying roughly 181% more than the national average. The fire is slightly less on fire. Congratulations, Palm Bay is feeling all of this, and it's only number 11. This is where the story starts, and it only gets more dramatic from here. Number 10, Port St. Lucie. Port St. Lucie was one of Florida's boomtown darlings during the pandemic. Remote workers flooded in, prices surged, and for a minute it looked like the Treasure Coast had hit the jackpot. The jackpot expired. The median home price is hovering somewhere between $378,000 and $400,000 depending on which month you pull data from, and the trend line is flat to slightly negative. That might sound stable, but context matters. Homes are sitting on the market for over 85 days on average. The sale to list price ratio has slipped below 97%, meaning sellers are routinely accepting offers 3% or more below asking. And new listings hit record levels in January 2026, the most since 2008 in some Florida markets. The Treasure Coast is learning a lesson that boom markets always learn eventually. When prices shoot up 40 or 50% in 2 years, they don't stay there just because you want them to. Gravity applies to real estate too. Port St. Lucie's insurance situation mirrors the state. Premiums that feel disconnected from reality, flood risk that FEMA keeps reevaluating upward, and a buyer pool that's doing math on the total cost of ownership instead of just staring at the mortgage payment. That total cost math is what's killing Florida markets across the board. Think about it from a buyer's perspective. You find a house listed at $390,000. Your mortgage payment at current rates is maybe $2,400 a month. Manageable. But then you add homeowners insurance at nearly $700 a month, flood insurance at $250, property taxes at $500, HOA if applicable. Suddenly, your actual monthly cost is pushing $4,000 on a house that's listed under $400,000. The sticker price looks fine. The carrying cost looks like financial quicksand, and buyers in 2026 are finally doing that full calculation before making offers, which is exactly why sale prices are landing 3, 4, 5% below asking. This is where the correction starts to feel less like a blip and more like a pattern. And the next city on the list makes the pattern impossible to ignore. Number 9, Ocala. This one is genuinely weird. Ocala, sitting in Marion County in north central Florida, posted the fastest metro population growth rate in the entire United States, 3.4%. People are pouring into Ocala, builders are building, demand exists, and prices are still falling. Adam data flags the Ocala metro as declining even while it leads the nation in growth. That should not be possible in a normal market. When demand outstrips supply, prices go up. That's economics at its most basic, unless something else is breaking the equation. That something is the cost of ownership. When insurance premiums eat $8,000 a year, when property taxes are surging across the state, and when flood insurance adds another layer on top, the pool of people who can actually afford to buy shrinks, even when the pool of people who want to buy is enormous. Ocala is proof of a structural shift in Florida real estate. Growth does not automatically mean appreciation anymore, not when the carrying costs have fundamentally changed. A family that qualifies for a $320,000 mortgage might look at the annual insurance bill, the property tax bill, and the flood insurance bill and realize they can really only afford $260,000. That gap between what people want to spend and what they can actually afford after factoring in Florida's ownership costs is the invisible force dragging prices down in city after city. And Ocala isn't some coastal hurricane zone. It's inland. It's in horse country. The fact that even Ocala is experiencing price declines tells you something critical about what's happening in Florida. This isn't just a coastal problem. This isn't just a hurricane problem. The insurance and cost of ownership crisis has metastasized into the entire state, including the parts that were supposed to be safe from exactly this kind of thing. Keep that in mind because this exact dynamic is about to show up in every remaining city on this list. Number 8, Lakeland. Lakeland and its neighbor Winter Haven sit in Polk County, sandwiched between Tampa and Orlando. For years, this corridor absorbed spillover demand from both metros. People who got priced out of Tampa moved east. People who got priced out of Orlando moved west. Lakeland was the affordable middle ground. Then the inventory dam broke. In April 2025, Lakeland recorded one of the steepest single-month price dips in the entire country. Not because demand disappeared overnight, because supply exploded. Listings flooded the market faster than buyers could absorb them, and when supply outpaces demand in a market where insurance costs are already squeezing buyers, prices only move in one direction. Polk County's situation is a microcosm of what's happening across the state. Florida set a record for new January listings in 2026. Statewide, the share of listings with a price reduction climbed from about 21% in December 2025 to over 25% by May 2026. In Southwest Florida, that number exceeds 40%. 4 out of 10 sellers are cutting their price. Lakeland isn't in Southwest Florida, but it's absorbing the same pressure from a different angle. The Tampa market is correcting, which means the spillover buyers who used to land in Lakeland now have options closer to the coast. And when your primary buyer pool has alternatives, your pricing power evaporates. Lakeland's other problem? Nearly half of all Florida transactions are now cash sales. When cash buyers dominate a market, finance buyers, the ones who need a mortgage and therefore need insurance, lose leverage. Cash buyers can close faster, skip the appraisal headaches, and avoid the entire insurance qualification nightmare. That means the families who actually want to live in Lakeland are competing against investors who can sidestep the state's biggest cost burden entirely. If you're finding any of this useful, by the way, that subscribe button is just sitting there doing nothing. Give it a purpose. Number 7, Daytona Beach. Daytona Beach, along with the broader Daytona-Ormond Beach Metro, is down 8.2% year over year, according to Zillow. That's a significant hit, and it lands in a market that was never particularly expensive to begin with. A typical Daytona Beach home is valued around $259,000. Losing 8% of that means roughly $21,000 in value gone in 12 months. For a homeowner who put 10% down on a $280,000 purchase, that $21,000 decline represents the majority of their equity. Some buyers from 2022 and 2023 are now underwater. Daytona's vulnerability comes from a combination of factors that stack badly together. The housing stock skews older, which means more buildings falling under the state's new milestone inspection requirements. The coastline is exposed to hurricane damage, which directly impacts insurance availability and pricing. And the condo market along the beach is getting squeezed by the same SB4D structural safety laws that are wrecking condo values across the state. Those condo laws, by the way, deserve a quick explanation because they come up repeatedly in this countdown. After the Surfside condo collapse in June 2021 that killed 98 people, Florida passed legislation requiring structural inspections at 30 years for most buildings and 25 years for buildings near the coast. The law also mandated reserve studies and banned the common practice of condo associations waiving reserve contributions. The deadline for compliance was January 1st, 2026. The result? Condo buildings across Florida are discovering they need millions of dollars in repairs. That cost gets passed to unit owners as special assessments ranging from $20,000 to over $400,000 per unit. Owners who can't pay are forced to sell, often at a loss. Buyers won't touch buildings with pending assessments, and banks won't finance units in buildings that fail inspection. That dynamic alone has dragged down condo values nearly 10% statewide. In Daytona, where condos represent a meaningful chunk of the housing stock, the impact is amplified. Daytona is also on Realtor.com's list of Florida metros with the steepest 2026 declines, and the metro to the south on that same list is even worse. Number 6, Punta Gorda. This is where the countdown gets dark. Punta Gorda, the seat of Charlotte County on Florida's Gulf Coast, has dropped 25.3% from its July 2022 peak. That's the largest peak to current decline of any Florida metro, not the largest monthly drop, not the largest quarterly dip, the largest total decline from the high water mark, a quarter of the market's value gone. Year over year, Zillow shows Punta Gorda down 9.6%, with a typical home value around $334,000. Realtor.com data from early 2026 shows Punta Gorda had the biggest percentage list price drop in the state, a median decline of roughly $26,000. But the number that really tells the story is the inventory spike. Charlotte County's active listings surged to 114% above its historical norm, more than double the normal supply of homes sitting on the market. In real estate, that kind of inventory explosion is the housing equivalent of a fire sale. Charlotte County took a direct hit from Hurricane Ian in September 2022, and then absorbed further damage from Hurricane Milton in October 2024. The back-to-back storms didn't just wreck buildings, they spooked the insurance market, accelerated premiums, and created a sustained wave of sellers who decided that the combination of storm risk, insurance costs, and declining equity made staying untenable. People are leaving Charlotte County, not because they don't love the Gulf Coast sunsets, because the sunsets started costing 25% of their home equity per storm cycle. And the sellers who are staying? They're in a brutal position. 74% of listings across the Cape Coral-Fort Myers metro, which includes Charlotte County, are taking price reductions. That means nearly 3 out of 4 sellers list their home, get no offers at asking, and slash the price. Some of them slash it again and again. In a market where inventory is 114% above normal, there is no urgency from buyers. Buyers in Charlotte County right now are in the driver's seat, and they know it. Every week a home sits unsold, the seller's negotiating position gets weaker. The next city on this list led the entire nation in one of the most closely watched housing metrics for over a year. And yes, it's the one you're thinking of. Number 5, Tampa. Tampa's decline made national headlines because it showed up in the data that institutional investors and Wall Street analysts actually pay attention to. The S&P Case-Shiller Home Price Index, which tracks repeat sales in 20 major metros, showed Tampa posting negative 3.9% year over year through November 2025. That was 13 consecutive months of decline, and it made Tampa the worst performer among all 20 cities tracked. 13 months straight of falling prices on the most credible housing index in the country. That's not a seasonal blip, that's a trend. The decline has since moderated to around negative 1.8% by April 2026. So Tampa isn't accelerating downward anymore. It's stabilizing, but at a significantly lower level than where it was. Redfin's 3-month median puts the Tampa sale price around $443,000. Tampa's problems are compounded by population loss. Pinellas County, home to St. Petersburg and the western edge of the Tampa metro, lost nearly 12,000 residents in 2024 and 2025 combined. County leaders pointed directly at the back-to-back hurricanes, Helene in September 2024 and Milton in October 2024, as accelerants. When hurricanes roll through and insurance companies respond by jacking rates or leaving entirely, some residents simply calculate that the risk-reward ratio no longer works. The condo market in Tampa is experiencing the same SB4D pressure seen statewide. Statewide condo supply reached 13 months of inventory in 2026, deep into buyer's market territory. In Tampa specifically, older high-rise condos along the waterfront face the most severe inspection and reserve requirements, and the special assessments that follow are driving owners to sell at prices that would have seemed absurd 3 years ago. And here's a detail that should concern anyone looking at Tampa condos specifically. Roughly 5,000 Florida condos sit on Fannie Mae's unavailable list, meaning conventional lenders refuse to finance purchases in those buildings. 696 of those buildings are in the Miami-Dade, Broward, and Palm Beach corridor, but Tampa's aging waterfront towers are increasingly joining the list. When a building hits the unavailable list, the only buyers who can transact are cash buyers, and cash buyers don't pay full price. They want a discount, a steep one. Tampa is the city that proved this isn't a regional Southwest Florida problem. It's a statewide crisis showing up in the most tracked data on the planet. Number 4, Sebastian and Vero Beach. Indian River County sits on Florida's Atlantic coast, and Sebastian Vero Beach has traditionally attracted retirees looking for a quieter, less expensive alternative to Palm Beach or Fort Lauderdale. Quieter, yes. Less expensive? That depends on how you define expensive, because the total cost of owning a home in Indian River County just got a lot more painful. List prices in the Sebastian Vero Beach metro dropped 8% from February 2024 to February 2026, a decline of roughly $38,000. Time on market increased 61%. Homes that used to sell in 45 days are now sitting for over 70. The Atlantic coast of Florida faces the same FEMA flood map, reclassifications hitting the Gulf side, and Indian River County's barrier island communities are particularly exposed. When FEMA updates a flood map and your property goes from Zone X to Zone AE, your flood insurance doesn't just increase. It fundamentally changes the economics of your home. A property that cost you nothing in flood insurance might suddenly require $3,000 or $4,000 a year, on top of the $8,000 you're already paying for wind and hazard coverage. An EDF study on risk rating 2.0 found that the new pricing caused an 11 to 39% decline in new flood insurance policies and a 5 to 13% drop in renewals nationwide, with the largest coverage losses among lower income households. That means people aren't just paying more for flood insurance. Some of them are dropping coverage entirely, which creates a different kind of risk. An uninsured home in a flood zone is a financial time bomb waiting for the next storm surge. Sebastian Vero Beach is what happens when a quiet retirement market gets caught in the crossfire of a statewide insurance catastrophe. Nobody moved to Vero Beach expecting to deal with this, and that's exactly why so many people are listing. Number 3. Naples. Naples is one of the wealthiest zip codes in America, and the decline here carries a different flavor. This isn't a working class market squeezed by affordability. This is a luxury market where millionaires are doing the same math as everyone else and arriving at the same conclusion. The numbers don't work. Home prices in the Naples Marco Island metro are down 4 to 6% year over year, which sounds moderate until you consider the dollar amounts involved. 4% on an $800,000 home is $32,000. On a $2 million home, that's $80,000. Monroe County, which covers the Florida Keys and sits adjacent to the Naples luxury ecosystem, has the highest average insurance premium in the state, over $22,000 per year. Miami-Dade, where many Naples buyers also hold property, averages nearly $16,000. Palm Beach County averages over $14,000. The Southwest Florida luxury condo market has been hit especially hard by the new reserve requirements. Buildings that deferred maintenance for decades, sometimes on purpose to keep HOA fees low and attract buyers, are now confronting engineering reports that detail millions in necessary structural work. And the owners who bought into those buildings expecting low fees and easy appreciation are discovering that the bill has come due, literally. HOA fees in Miami-Dade. High-rises jumped nearly $500 per month in 2025 alone. That's $6,000 additional dollars a year just in monthly fees before you even get to the special assessment. The stacking of insurance, property taxes, HOA increases, and special assessments is creating a cost of ownership environment where even wealthy buyers are walking away from deals. When the rich start walking, you know the math is truly broken. Number 2. Northport. Northport sits in the Sarasota-Breton metro, and the decline here is both severe and personal. Home values are down 7.5% year over year, and from the 2022 peak, the drop reaches 17.4% according to Resi Club analysis, nearly 1 in $5 of home value erased. Northport's location made it especially vulnerable. Hurricane Milton made landfall as a Category 3 storm near Siesta Key in October 2024, and the Sarasota Metro took the hit directly. In the week after Milton, new pending home sales in Sarasota dropped 66.7%. New Tampa area listings fell nearly 79%. The market essentially froze. When it thawed into a correction. Buyers who were already hesitant about Florida's insurance costs now had a fresh Category 3 hurricane reinforcing every fear they'd been calculating. CoreLogic estimated that roughly 500,000 homes, worth about $123 billion, were at risk in the Tampa-Sarasota metros from Milton's storm surge alone. Northport was supposed to be the affordable alternative to Sarasota proper, a place where young families could buy into the Gulf Coast lifestyle without Sarasota's price tag. That value proposition still technically exists, but the insurance math rewrites it completely. A $350,000 home in Northport with a $7,000 annual insurance bill and $3,000 in flood insurance carries a monthly cost burden that rivals a $450,000 home in a state with normal premiums. The discount isn't really a discount once you factor in what Florida charges you just to exist there. And that brings us to the absolute bottom of the list. Number 1, the Cape Coral and Fort Myers Metro. These two cities share a metro area, share a county, and share the unfortunate distinction of being the single hardest hit housing market in the United States right now. They earned the number 1 spot together because the data says they belong here together. Fort Myers is ground zero for Hurricane Ian, which made landfall in Lee County in September 2022 as a Category 4 storm and caused roughly $65 billion in insured losses. It was one of the most expensive natural disasters in American history, and the market still hasn't recovered. Zillow home values in Fort Myers sit around $310,000, down 8.4% year over year as of mid-2026. From the 2022 peak, many Fort Myers homes have lost 15 to 20% of their value. Redfin shows a median sale price of $348,000, with days on market stretching past 74 and roughly a quarter of all listings taking price cuts. Fort Myers' decline is a case study in how a single catastrophic event can permanently reshape a housing market. Hurricane Ian didn't just damage homes. It exposed the fragility of the entire insurance infrastructure supporting them. In the year after Ian, 6 Florida insurance companies went insolvent. National carriers like Farmers announced they were pulling out of the state entirely, and all those abandoned policies flooded into Citizens, the state insurer of last resort, and then there's Cape Coral, right next door. Even worse. Cape Coral earned headlines because it earned the top spot on a much more important list. According to Atom data from early 2026, Cape Coral's median sale price dropped 9% year over year to $341,000. That made it the steepest decline of any major U.S. metro they track. Not the steepest in Florida, the steepest in the entire country. ResiClub pegs the Cape Coral Fort Myers peak to current decline at negative 18.8%. Nearly $1 in $5 of home value gone since 2022. Fox 4 ranked Cape Coral dead last among 123 mid-size U.S. cities for housing market momentum in July 2025. And 74% of listings are taking price reductions, meaning 3 out of 4 sellers are being forced to lower their asking price. Cape Coral also holds the 3rd highest insurance premium to value ratio in the nation at 2.2%. On a $350,000 home, that's roughly $7,700 a year just for homeowners insurance. Add property taxes, add flood insurance, add the mortgage. You're looking at a total monthly cost that makes the sticker price almost irrelevant. The deeper story in Cape Coral is a supply and demand imbalance that nobody saw coming. During the pandemic boom, Cape Coral was one of the fastest growing cities in Florida. New construction permits surged, subdivisions spread across the canal-lined grid, and then Ian hit, insurance costs exploded, and the demand that was supposed to absorb all that new supply simply didn't materialize at the prices sellers needed. Homes in Cape Coral are sitting on the market for 60 to over 100 days. Sellers who bought in 2021 or 2022 are looking at 5-figure losses if they sell today. Some are choosing to hold and hope. Others are cutting prices and moving on. Cape Coral's neighbor, Punta Gorda, already showed us what a 25% peak decline looks like. Cape Coral is currently at 18% and counting. Whether it catches up depends almost entirely on what happens with insurance costs, interest rates, and the next hurricane season. And if that entire countdown felt like watching a slow-motion financial disaster, well, that's because it is one. If you made it this far, you're officially more informed about Florida real estate than 90% of the people buying there right now. Hit subscribe so you catch the next one. We cover stories like this every week, and the way Florida's market is moving, there will absolutely be a next one. I'll see you there.